What's going on, everybody? My name is Matthew, and today I am sharing my thoughts on the 2021 stock market crash. Let's do it. Now, I want to start this off by saying macroeconomics has so much going on at all times that there's no way we can sum it all up in just a 10 to 20 minute video. And I'm not an economist, a macro professor, or anything like that. I'm just a person who's constantly trying to improve myself, learn, and be a student of the game. Also, it's pretty much pointless to try and predict a stock market crash because they are literally characterized by unpredictability, and that is largely why they cause panic. And the economists who are calling for a crash every year will eventually get it right. Until then, we're all pretty much like this puppy, in my opinion, completely clueless. At the same time, I think these videos can be very entertaining and often informative, and I had so much fun and I learned so much while making this video 5 months ago explaining why I thought we would have an upward trajectory for the rest of 2020. With that being said, I'm here today to share with you what I have observed and gathered so far, and I would love the conversation to continue down in the comments below. So here it is. I think we could be seeing the beginnings of a massive multi-year bull run, or at least through 2021, although I wouldn't be surprised to be a correction in the first half of this year. I'm not someone who tries to time the market or anything, but I think a big picture analysis is always important and something to keep in mind as an investor. To start it off, I want to define the word crash because I think that word gets thrown around way too loosely nowadays. A correction is when the market falls 10% from its 52-week highs over a few days, weeks, or even months, whereas a crash is a rapid and often unanticipated drop in stock prices. A crash can be a side effect of a major catastrophic event, economic crisis, or the collapse of a long-term speculative bubble. And that's the thing about crashes is that they're usually unexpected, and they strike fear and panic into not just us retail investors, but into everyone, even institutions. Or they're at the end of a long-term speculative bubble. And today I'm going to be explaining why I don't think we'll see an end to this bubble that we seem to be in anytime soon. And even if we are in a bubble, we've been in one for maybe 8 to 10 months. Bubbles can last for many years before they correct. On the topic of bubbles, I first want to talk about comparing now to the dot-com bubble, because that's the one that most people seem to be drawing comparisons to. Specifically, I want to focus on what is probably one of the most important movers in the stock market, the Fed. The Federal Reserve sets interest rates, which is basically how much it costs to borrow money, and this is hugely important for the economy. It's a lever used for times of economic expansion and contraction. The lower the interest rate, the less expensive it is to borrow money, and I'm sure many of you guys are aware of this. And the easier it is to borrow money, theoretically, the easier it is for companies to grow, expand, innovate, and hopefully increase earnings. At the same time, this can also lead to significantly low savings rates and bond yields. And when you see the PE ratios of the dot-com bubble, yes, they're right around where we are now, and this is often the argument used by people to justify us crashing soon. But when people point this out, they often don't take a look at the interest rates at the time. From 95 to 2000, the federal funds rate was way higher than today, bouncing between 4 and 6.5%. And the 10-year Treasury bond yield was in a similar range in the late 90s, approaching the dot-com bubble. So that means in the years leading up to the dot-com bubble and those sky-high PEs, it was actually harder and more expensive for businesses to borrow money than it is today. And if investors wanted a safe 5 to 6% return, they could go somewhere that wasn't the stock market, which was bonds. A safe 5 to 6% is still very attractive to conservative investors or people just trying to conserve capital and keep up with inflation. So if companies can't borrow easy, cheap money to expand their businesses and their earnings, and there's a safe alternative to the stock market yielding 5 to 6%, then it kind of makes sense why those PEs in the 30s during the dot-com bubble should definitely be labeled irrational exuberance and a bubble. And you can probably guess where I'm going with this. Today, the federal funds rate is less than 0.1%. It's almost at zero. This means borrowing money is extremely cheap and savings rates and bond yields are super low. We know this. And the Fed has pledged not to raise rates until 2023, meaning money should stay pretty cheap. Now, we're obviously yet to see if the Fed will stay true to that pledge, and there are some recent indications that they may start to raise rates a little bit earlier, but for now, this is the assumption that I'm going to take. So to wrap up this point, companies are in expansion mode as they have access to cheaper capital. And with the 10-year Treasury yield sitting around 1% versus the 5 to 6% you were able to get in the 90s, there's really no alternative to the stock market if you want your money to hold its value, let alone appreciate in value. And this brings us to TINA. Who is TINA? It stands for There Is No Alternative. And I do want to point out that I wrote this script before the new year, and recently there's been a development in the 10-year Treasury Yield, which is at 1.13% on Monday. And for a number of reasons, this could increase the volatility of the market and maybe put a damper on the growth rally. There's also the issue of the dollar losing value. With new administration planning to spend literally trillions of dollars, and with more stimulus coming to print more money, our money is being devalued. And the other thing is, real estate and other asset classes are also participating in this rally. So the question is everything going up? Or is the dollar just going down? You can see Bitcoin as evidence that people and now institutions are accepting the fact that we need a deflationary asset and a hedge against inflation. And at the same time, in a sense, it's almost like assets are kind of protecting us from inflation, because a lot of that new money that is coming to us and into our hands is actually going right back into the stock market. Now, moving on to the next kind of bearish argument is that simply the stock market has gone up too much this year. And to that I would say, well, the financial landscape of both the economy and the stock market has completely changed in 2020, now 2021. Yes, we're kind of in this thing called a recession right now, and the economy is not looking too hot. But at the same time, we have record low interest rates, which we didn't have in 2019. We've accelerated the momentum, innovation, and adoption of technologies in telecommunications, cloud, artificial intelligence, and e-commerce, just to name a few. Advancements that would have normally taken 2 to 3 years happened in just a few months in 2020, therefore rapidly increasing the earnings potential of many of these companies. And guess what? The top 6 companies most heavily weighted in the S&P 500 index are tech companies that have thrived throughout this global shutdown. It would be different if restaurant stocks were up 200% year to date, but that's not the case. It's these tech stocks that have actually seen an earnings boost throughout this whole situation. And speaking of restaurants, let's talk about cyclicals and consumer discretionary stocks for a sec. We've recently witnessed rotations between different areas in the stock market. We see days where recovery stocks, as they're now labeled, do really well. We see days where small cap stocks outperform large cap stocks. We see days where FANG rocks it and recovery stocks stay red. Pay attention to all of this. The bull market is broadening and reaching everyone and taking them all for a ride. It's not just tech having fun here. Rotations are a key part of a healthy bull market, so it is fantastic that we are seeing this happen today. Then there's also the argument that the economy is terrible. It's not great, but I'm sure you've heard this before. The stock market is not the economy. And again, I point to the weighting in the S&P 500 as a great first example of that. And there are signs of economic strength. Recent employment reports actually show that manufacturing employment was still recovering, and unemployment rates fell to 4.3% in December from 6.2% in September. And manufacturing, which I think is a good indicator of economic productivity, seem to be improving. Lastly, there are a lot of other things I could touch upon, like the recent rally in copper, the fact that most of the market is actually participating in this rally, and again, not just a few stocks, and global indices are also participating. And of course, we do now have the vaccine being deployed, which could potentially unlock a ton of pent-up demand for the economy. So moving forward, what am I going to do? Now, don't get me wrong, there's definitely a lot of greed and frothiness in the market right now, specifically in certain areas of the market that look more like they might be bubbles right now. If the music does stop sooner than we expect it to, then a company with no actual financials to really back up or justify their valuation at the time will probably get crushed. As we all know, I also think IPOs are really out of hand. I've been waiting to invest in many of them this year, such as Airbnb and Snow, and we all know how those went. But yeah, I don't think that we're at any sort of breaking point for this bubble we seem to be in, and I don't think we'll see a crash anytime soon. At the end of the day, I am carefully bullish, and what that means is I probably won't be averaging up as heavily on a lot of these growth stocks and high flyers, but I definitely won't be selling them. In fact, if I were an investor in today's market, which I am, I'm going to be keeping a close eye on my cost basis and how much I average up on these positions, because if the rug does get pulled out from under us, I want a lot of cushion there. I'm also going to be putting a lot of focus on the risk reward for new picks and focusing a lot on how much of a premium I'm willing to pay for some of these growth stocks. And I'm definitely going to try and stay within my circle of competence, or at least circle of understanding, and be realistic. I'm not going to come to you guys acting like I know what I'm talking about when it comes to genomic stocks. That's why I recommended ARKG so long ago. Unless someone has a background in genomics or they've dedicated weeks and months to studying a concept, I find it hard to believe that an investor can spend a day or one night studying a genomics company and know enough to comfortably invest in that company. But at the end of the day, everyone's a genius in a bull market. I see myself staying heavily invested in the market. I don't see myself dropping below maybe 5% cash, but definitely nothing more than 20 to 25%. That being said, I wouldn't be surprised if we see a correction in the first half of 2021, and that'll be the only sort of timing the market that I do. I'll just be changing the size of my cash position, but by no means am I going to time anything by selling any positions. And of course, the macroeconomic landscape is always changing, and so therefore, much of what I said in this video could change a month or maybe a few months from now. If you found any value in this video, and I hope you did, please make sure you hit that like button, subscribe, and check out our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching to this point in the video, you are the real MVP. Don't forget your peace and thank yous.